Capital structure. Plan of the lecture. Decision on capital structure is more art than science. We will go through several examples to illustrate basic issues on capital structure. Financing options. Investment can be either financed with equity or debt, or both. Equity financing lowers chance of financial distress. More risky projects often adopt equity financing to reduce the cost of bankruptcy and financial distress. Debt financing won't dilute ownership. Debt financing has tax benefit. Interest payment is tax deductible as business cost. Interest payment is fixed. Dividend payment is not fixed. Debt financing has lower information cost. For investors, debts are called fixed income securities. For issuers, debts are fixed costs for businesses. Equities are variable cost for businesses. This fixed cost, variable cost classification of debt and equity helps us integrate financial and operating leverages. Capital structure of a business. Debt-equity ratio is called capital structure of a business. How businesses determine their own capital structures? It is generally assumed to be a trade-off between tax benefits and the risk of financial distress. Debt and overall risk of project. Debt generates tax saving. The tax saving part is from the safer part of cash flows, since debt is senior over equity. Hence, that reduces the risk of overall cash flows. At the same time, debt is fixed cost of project. This increases the risk of project. The overall impact is mixed. When the debt level is high, that will increase the overall risk of the project. When the debt level is low, probably that will reduce the overall risk. Optimal debt-equity ratio, a quantitative method. In textbooks, we qualitatively discuss the issue of optimal debt-equity ratio. Here we will discuss a quantitative method to determine optimal debt-equity ratio. It is a preliminary method. It would be great if you can improve the method. Example 1. A company has a pre-tax cash flow of $10 million per year to perpetuity. The tax rate is 40%. The unleveraged discount rate for the cash flow is 10% per year, according to its risk level. The risk-free borrowing rate is 4% per year. The company decides to borrow X million dollars to finance its operation. The maturity of the loan is perpetuity. The interest rate on its loan is 4% plus 0.0001 times x squared. This means interest rate on this loan is higher with more borrowing. Suppose the asset discounting rate is 10% plus 0.0001 times x squared where 10% is the unleveraged discount rate for the cash flow. Here are the questions. What is the company value without debt? At what debt level the company value as the sum of debt and equity reaches maximum? What is the maximum company value? Solution. First, we calculate company value before debt borrowing. Cash flow after tax is equal to 10 million times 1 minus 40%. Here 40% is the tax rate. The result is $6 million per year. Company value is 6 divided by 10%. Here 10% is discounting rate because cash flow of 6 million go to perpetuity. The answer is $60 million. Now we assume the company borrow X million dollars. The interest rate is 4% plus 0.001 times X squared. Annual interest payment is the principal times the interest rate, which is X times 4% plus 0.0001 times X squared. Annual tax saving from interest payment is the amount of interest payment times the tax rate, which is 40%. For the project, the cash flow after tax saving is the original cash flow after tax plus the amount of tax saving. And the discount rate on this cash flow is the 10% plus the extra because of borrowing. So the value of the asset is total cash flow divided by the discount rate on this asset. We use Excel solver to solve the maximization problem for the asset value. We try to maximize asset value and we find out the maximized asset value is 61.16 million when the borrowing is at $15.41 million. With optimal capital structure, we gain 1.16 million value from 60 million to 61.16 million. That's a lot, right? For Excel calculation, please refer to this Excel sheet. It's worksheet example 1. Now we study the relation between tax rate and capital structure. With this model, we can study the relation between tax rate and capital structure. Intuitively, with a higher tax rate, debt borrowing provides more tax saving. So we would expect more borrowing with a higher tax rate. Calculation confirms our intuition. The detailed calculation can be found on the same Excel worksheet. Possible presentation topics. We can discuss if the above method is realistic, how to improve the quantitative method, or to develop a new quantitative method for determining a good capital structure for businesses. We can also study the empirical relation between tax rates and capital structure. Debt and equity financing with different output scenarios. When we choose debt or equity financing, When we choose a certain capital structure, we have certain output scenario in mind. However, the actual output may differ from the expected output. With different outputs, what will be the original owner's financial outcome? We will look at it in the next example. Example 2. A project requires initial investment of $5 million. The project will last for 10 years. Suppose annual output is $2 million. The variable cost in production is 60% of the output. What is the annual gross profit of the project? If the discount rate is 8% per year, what is the net present value of the project? The project requires $2 million external financing, either by debt or equity. Interest rate for debt is 5%. What is the annual repayment for the debt with 10 equal annual installments? With equity financing, the external investor will require 8% of expected return. What is the share of equity for the external equity investor? If the realized annual output from the project are 1 million, 2 million, or 3 million respectively, how much dividend will the original owner receive with debt and equity financing? What conclusion you can make? Solution. First, we will calculate the results when the annual output is $2 million. In this case, annual gross profit is 2 times 1 minus 6%, which is equal to $0.8 million. Here, 6% is the variable cost. The net present value of the project is the present value of future profits minus the initial investment. Here are the parameters. Annual profit 0.8 million, discount rate 8%, duration 10 years, the initial investment is 5 million. So net present value is equal to 0.8 divided by 8% times 1 minus 1 over 1 plus 8%, all with power of 10. And then finally the minus 5. The initial investment, the answer is 0.368 million. Now we will look at what is expected annual dividend for this $2 million equity financing. The answer is 2 times 8% divided by 1 minus 1 over 1 plus 8% to the power of 10, which is equal to $0.298 million. So we use the same formula again and again, right? This is the most important formula in finance. And what is the share of the total dividend and hence equity by external investor? So the share is its dividend, which is 0.298 million, over the total profit is 0.8 million, and the ratio is 37.3%. This means when the external equity investor put in $2 million, it will receive 37.7% of the profit from this investment. Let's continue the solution. We will discuss debt financing and annual dividend paid to the original owner in different scenarios. Annual payment with 10 equal installments for 10 million debt with 5% interest is 2 times 5% over 1 minus 1 over 1 plus 5% to the power of 10. This is equal to 0.259 million. Annual dividend for original owner with debt financing is the earning minus debt interest payment, which is 0.8 minus 0.259. The result is $0.541 million. With equity financing, annual dividend for the original owner will be 0.8 minus 0.298. This is the share by the external investor. The result is 0.502 million. The calculations are presented in the next slide. Here are the results of Excel calculations. The Excel sheet can be found with the same file. So we have initial investment, annual output, variable cost, duration to 10 years. We can calculate annual profit. The discount rate is 8%. We can calculate the net present value. Now we suppose there's debt financing and equity financing of $2 million. For debt, the discount rate is 5%, and the annual payment for debt is 0.259. For external equity financing, we can calculate the dividend received by the external investor, and we calculate the share of equity for the external investor, and finally we can get the dividend for the original investor, which is total earning minus either debt payment or the payment to external equity investor. When the annual output is 1 or 3 million, respectively, we can redo the process. The results are summarized in the following table. So from this table, you can see when the annual output is $2 million, then the dividend payout with debt and equity are roughly the same. When the annual output is $1 million, less than expected, the dividend with debt is lower, dividend with equity is higher. When the annual output is 3 million, which is higher than expected, then dividend with debt is higher and dividend with equity is lower. Discussion. So we pretty much have done discussion in the last slide, right? Now we will talk about capital structure and information asymmetry. So when the original owner's expectation is similar to the public expectation, different financing options don't make much difference for the original owners. When the original owner's expectation is worse than the public expectation, equity financing is preferred. When the original owner's expectation is better than the public expectation, debt financing is preferred. For Excel calculation, please refer to the same Excel file on the worksheet of example 2. Uncertainty in investment outcome and financing choices. Different investment projects have different levels of uncertainty in their outcome. How the levels of uncertainty affect the choice financing methods. We will examine this in the next example. Example 3. Financing choices of two different projects. Both projects require initial investment of 100 million. Both require 40 million external financing. The payoff of the first project, 140 million with 80% probability, 30 million with 20% probability. The payoff of the second project, 120 million with 98 probability, 30 million with 2% probability. The expected payoff of the first project is 118 million. Of the second project is 118.2 million. They are roughly the same. For debt financing, cost of banks' funds is 2%. The required return on banks' assets is 2.5%. Salvage ratio in bankruptcy is 60%. For equity financing, the required rate of return is 10%. This is 5.5% higher than return on debt. This is very, very high. Related calculation on first project. Debt financing, assume the loan rate is X. The amount of loan is 40 million. The expected return is 40 times 1 plus X, which has 80% chance, plus 30 times 60%, which is the salvage ratio, times 20% chance, should be equal to the required rate of return, right? Which is 40 times 1 plus 2% plus 2.5%. We can solve the problem to get the loan rate is 19.4%. The expected payoff for project owners after paying debt is 140 minus the debt payment times 80% is equal to 73.8 million. So in the other 20% cases, there's no payment, or the payment for the project owner is zero because it's not enough to cover the debt. With equity financing, it requires 10% required return. So the total required return is 40 times 1 plus 10%. This is 44 million. The expected payoff for project owners after paying external equity investor is 118 minus 44. This is equal to 74 million. From the numbers on expected of external financing with equity is slightly better. Furthermore, with equity financing, volatility of return is reduced. Hence, equity financing is preferred. Related calculation on the second project, debt financing. Assume the loan rate is Y. The amount of loan is 40 million. And we can use the same method to calculate this loan rate. And here Y is equal to 5.7%. So this is much lower than the first project because the uncertainty is much lower. The expected payoff for the project owners after paying debt is 76.2 million. With equity financing, it required 10% required return, so the total required return is 44 million. Expected payoff for project owners after paying external equity investor is 118.2 minus 44 is 74.2 million. Summary: from the numbers on expected payoff, external financing with equity is $2 million less than financing with debt. Hence, debt financing is preferred. In conclusion, low-risk project favors debt financing. High-risk project favors equity financing. Discussion: in the second project, we can argue that since the project is of low risk, the required return on equity should be low as well. This is certainly true. However, there are many different kinds of uncertainties for external equity investors. For example, the insiders may spend company profits on personal enjoyment. The managers may pay themselves high salaries and bonuses. These factors make the required return on equity high. Even the operations themselves may be of low risk. Mixed financing. For many project investments, we use both debt and equity financing. In the next example, we study how pure debt financing, pure equity financing, and mixed financing affect the final financial outcomes. Example 4. Assume the bank's borrowing rate is 2% per annum. A business applies for 25 million loan for a project and plans to repay the loan in 1 year. A loan officer estimates the payoff from the project will be 40 million with 80% probability and 20 million with 20% probability. If a loan defaults, on average, the bank can get 60% of the salvage value. If the bank requires 2.5% return on its loans, what would be the loan rate? Here is the Excel calculation. So we assume all these conditions: risk-free rate, required rate of return on bank loan and amount of loan, the payoff structure, and the salvage ratio. So we get this: the required payment loan is 25 million times 1 plus 2% plus 2.5%. that turned out to be 26.125 million. So we assume the loan rate and we calculate the expected repayment of loan and make this equal to the required repayment of loan, and we find out the loan rate is 18.63%. And with this, the expected payoff for original investor is $8.274 million. And all this is available from the Excel file. Next, we consider mixed debt and equity financing. With 15 million equity and 10 million debt, what would be the loan rate? We assume required equity return is 10%. What would be the share of ownership for external equity investors? What would be the expected amount of return for the original project investors? How is this result compared with pure debt financing? Excel calculation. We set debt financing to be 10 million, equity financing to be 50 million. And we calculated the loan payment after 1 year, 10.45. Here there is no possibility of the default because the lowest output for the project is 20 million. So the loan will already be paid back in full. So the interest rate is 4.5%. And then we pay off after loan payment is for equities, right? For equities, and this equity is shared by this external equity holder and internal equity owner, okay? And we can calculate, because we know the required return for external equity investor is 10%, so we can calculate the required payment for the external equity investor, and share of external equity is 64.58%, and expected payoff for original investor is 9.05 million. Note, since the financing has less debt, the payoff is less risky, and the debt itself is risk-free. The saving comes from the absence of liquidation cost or bankruptcy cost. Now we consider funding with pure external equity. Assume required equity return is 9%. What would be the share of ownership for external equity investors? What would be the expected amount of return for the original project investors? How is this result compared with pure debt financing and mixed debt and equity financing? Now let's look at the case of the purely external equity financing. The amount is 25 million. The required return for external equity is 9%. The required payment as a result is 25 times 1 plus 9%. This is 27.25 million. The expected payoff from the project is 36 million. This is 40 million times 80% probability plus 20 million times 20% probability. Share of external equity is 27.25 divided by 36 is roughly 75%, and what's left over is for the original investor is $8.75 million. We were discounting the final payoff for the original project investor by respective discounting rates. In the mixed case, it's 10%. In the pure equity case, it's 9%. So we get in the mixed financing, we get 8.23. In pure equity, we got 8.03. So mixed financing is preferred. For pure debt financing, discount rate for the equity owner would be the highest because what's left over for the equity owner is the most risky. Calculate the optimal financing ratio can be tricky. When debt approaches default level, interest rate increase substantially. We usually seek good but not necessarily optimal financing ratio because we don't really know where the optimal ratio is. Comments: we use rough estimates for discounting on equity. We also use the same rate of return on debt financing, regardless of risk level. To fine-tune discounting on debt and equity, we need to apply CAPM, but CAPM has its own problems.